Hey there. Have you ever landed on a web page for some investment fund and just felt completely lost? Like, what does all this even mean? Well, if that's you, you're in the right place. Today, we're going to take one of those pages and we're going to treat it like a map. We'll go on a little guided tour together, step by step, to figure out what it's really trying to tell us. Ready? Let's dive in.
Okay, but before we dive in, we have to start right here. This is super important. And look, this isn't just some legal mumbo-jumbo they make us say. It's actually the whole point of what we're doing today. The goal here is for you to get better at understanding this stuff for yourself. Think of this as learning how to read the map, not me telling you which way to turn.
All right, so here it is. This is our map for today's journey. It's a snapshot from the official page for the Vanguard Growth ETF. You'll often see it called by its ticker symbol, VUG. You can think of this page as the fund's business card, right? It's got all the headline info. So we're going to start here with what's on the surface before we dig a little deeper into the fine print. So here's our game plan. First, we'll hit the vitals, the quick at-a-glance stuff. Then we'll get into what it actually means for this thing to be an index fund. After that, we'll talk about the cost of investing, because nothing's free. And then, and this is maybe the most important part, we are going to read the risk warnings. Finally, we'll wrap it all up with the big takeaway. Okay, let's get into it. Section 1, the vitals. This is the stuff that jumps right out at you when you first land on the page. It's designed to give you that quick first impression. So this table basically helps us put the fund in a box to classify it really quickly. You've got the ticker, VUG, which is just its nickname on the stock market. Management says index. That's a huge clue about its strategy, and we'll circle back to that in a sec. And then asset class and category tell us what it's buying. Stocks from big US companies that are, expected to grow. All right, next up, you see this number 4 out of 5. That's Vanguard's own risk scale. And yeah, a 4 is pretty high up there. So you got to ask, why so high? Well, a lot of the time, it's a sign that a fund is really concentrated in certain types of companies, like those growth stocks we just mentioned. But don't worry, we're going to find the exact reason for this when we get to the risk section later on. Okay, on to section 2. Now this is where it gets interesting. We saw that word index under management style. So what in the world does that actually mean for someone investing in it? Okay, to put it really simply, an index fund isn't trying to be a genius. It's not trying to outsmart anyone. Its only job is to copy or mirror a specific part of the market, which is called an index. This is what people call a passive strategy. See, it's not trying to beat the market, it's just trying to be the market, or at least that specific slice of it. And this chart really nails the difference. On one side, you have VUG's passive approach. The buying and selling is basically on autopilot. It just does whatever the index does. On the other side, you have active management. That's where a real-life fund manager is at the wheel, actively picking stocks, trying to find the next big winner. And as you can probably guess, paying a person to actively manage your money almost always means you're going to pay higher fees. Now here's something you might not expect, dug up from the fine print. It turns out the specific index that VUG is supposed to be tracking has actually changed, a few times actually. It started with one, then switched to another, and now it's on a third one. It's just a great reminder that even a so-called passive fund isn't necessarily set in stone forever. All right, time for section 3, the cost. You know the old saying, nothing in life is free? Well, that definitely applies to investing. Every single fund has a price tag, and it's called the expense ratio. So for VUG, the expense ratio is 0.04%. Let's make that real. What does that actually mean? It means that for every $10,000 you invest, you're paying about $4 a year in fees. Simple as that. Now, $4 might sound like nothing, right? But believe me, over many, many years, these little fees can make a huge difference in your returns. And like with most things, context is everything. That 0.04% is already super low, but look at this chart. It really puts it in perspective. It's not just a little lower than the industry average, it's more than 5 times cheaper. That is a massive difference. And this right here is one of the biggest selling points of that whole passive index tracking strategy we were just talking about. Lower costs. Okay, everybody, we've arrived at section 4. And I'm not kidding when I say this is probably the most important stop on our entire tour. This is where we look past all the performance charts and the cool numbers and really get down to the potential downsides. I'm just going to read this out and let it sink in for a second. All investing is subject to risk, including the possible loss of the money you invest. And notice this isn't buried in some tiny footnote on page 50. It's right there. It is the #1 rule of investing. There are absolutely no guarantees.
So the first risk they list is the big one, stock market risk. It's the most basic kind. Basically, it means that even if VUG does its job perfectly and tracks its index without a hitch, the entire market can still go down. And if that happens, your investment is going down with it. It's kind of like the price of admission for investing in stocks at all.
Next, we have something called sector risk. And the document is super clear about this. A huge chunk of VUG's money is in the technology sector. So what does that mean? It means if the entire tech industry has a really, really bad year, this fund is going to feel that pain a lot more than a fund that's spread out more evenly across the whole economy. And that idea leads right into the next one, non-diversification risk. And folks, this is a biggie. Because the fund has to track its index, it might end up putting a massive amount of its money into just a handful of giant companies. Its fate becomes tied to how well a few big stocks do. And this is a huge reason for that 4 out of 5 risk rating we saw at the very beginning. And finally, there's this whole bucket of risks that are all tied to the fact that it's an index fund. You've got passive management risk, which means, hey, you're just along for the ride with the index, good or bad. There's tracking error risk, which means the fund might not perfectly match the index. And there's even a risk that the company that creates the index makes a mistake. It's all part of the deal. Okay, that brings us to our final section, the key takeaway. After all of this, what's the big lesson we should walk away with? It's really about having a process, a checklist you can use for any fund you look at. First, check the vitals for the basic profile. Second, make sure you understand the strategy. Is it an index fund or something else? Third, check the costs, the expense ratio. And finally, and I can't say this enough, always, always, always read the risks. You have to understand what you're signing up for.
And while you're doing all that, you need to have this one phrase burned into your brain. You see it everywhere in these documents for a reason. Past performance is no guarantee of future results. Just because an investment was a rock star last year, or even for the last decade, tells you absolutely nothing about what it's going to do tomorrow.
So at the end of the day, remember this. The goal isn't to hunt for some magical, secret investment that has zero risk. It doesn't exist. The real goal, the smart goal, is to understand clearly and honestly the specific risks you are taking. That way, you can make an informed decision about whether those risks are a good fit for you. So we've just taken one of these complicated-looking pages and broken it down piece by piece. You now have a framework, a new way of looking at this stuff. So the only question left is, now that you know how to read the map, what are you going to go decode next?